I've seen tons of new investors talking about investing in NIO, so on today's video, I'm going to analyze the electric vehicle company and will give you a detailed answer whether you should buy, sell, or just leave it. NIO is an electric vehicle company headquartered in Shanghai, China. The company is perhaps best known for pioneering its battery as a service offering, which greatly reduced the upfront cost of purchasing their vehicles by offering consumers a subscription model. In addition to designing premium automobiles, the company is also investing heavily into artificial intelligence. In November 2019, the company announced a partnership with Mobileye to develop a Level 4 autonomous car ready for sale by 2022. Then in 2021, the company announced that it would be partnering with NVIDIA and utilizing the company's Orin chips for their next generation of vehicles. In addition to working in artificial intelligence, the company is also investing into its battery supply chain, charging infrastructure, and to lesser extent, fashion and consumer products with its NIO Life brand. NIO is operating in an extremely competitive environment. NIO faces competition from legacy internal combustion engine manufacturers such as BYD, SAIC, and Geely, which offer automobiles at attractive price points and are moving into the EV market in their own right. Apart from that, a new crop of upstart EV companies such as LI Auto and XPEV are also pursuing a similar strategy to NIO. NIO has a complex organizational and legal structure. After the company nearly went bankrupt in early 2020, it received a bailout from the government of Hefei and Wei. As part of this agreement, NIO was forced to contribute its assets, intellectual property, and cash to a holding company, shown below as NIO Holding Co. Limited. The Hefei government and strategic investors associated with its invested cash into the holding company exchanged for 24% equity stake and certain shareholder rights. Even why I think this agreement was damaging for NIO, there are analysts that believe the agreement was actually very good for shareholders, simply to allow the participation of government with minimum implication held back to them, including CEO Mr. William Li. They built this smart structure with NIO Holding Company in the center. The holding company is where the government has a minor stake, and as you can see in the diagram, all the companies named XPT aren't under its control, but 100% owned by NIO shareholders nonetheless. One analyst adds XPT is the heart of NIO, where the real long-term value is. The value is not in car assembly, but in the manufacturing of powertrain motors and other strategic components. The reason why XPT is not under control of NIO Holding seems to be twofold. Shareholders keep 100% of the ownership of what is really important, and XPT can also freely sell to other car manufacturers willing to join the power swap model. So over the course of the past 10 months, NIA has worked to repurchase the minority stake owned by those strategic investors, and as of this date currently owns 90% of the NIO holding company, as detailed in a recent 6K. Why is this so important? The answer is simple. First, the inability of management to successfully manage liquidity, which necessitated a bailout and a dilution of existing equity base, should give investors pause. Second, NIO Incorporation, the publicly listed company, only owns 90% of what investors may think of as NIO. Therefore, at a current market cap of $93.5 billion, investors are actually presumably underwriting the NIO holding company limited business at a valuation of over $100 billion. NIO Incorporation, the company in which investors own shares, is actually a Cayman Islands-based variable interest entity. Why are investors investing into a Cayman Islands-listed VIA instead of the NIO holding company directly? In essence, law prevents foreign ownership of domestic businesses, especially those with technological assets. In order to circumvent those rules, the founders of NIO established two PRC-based companies, Beijing NIO Network Company Limited and Shanghai Anbin Technology Co. Limited, to hold certain IP permits and licenses. Those two companies then entered into a contractual agreement with NIO Co. Limited, effectively pledging their equity interest to the company. While this arrangement may seem straightforward, it opens up significant risks in terms of shareholder rights and legal risks. NIO also goes on to highlight another risk as they add, if the PRC government deems that our contractual arrangements with our variable interest entities do not comply with the PRC regulatory restrictions on foreign investment in the relative industries, or if these regulations or the interpretation of existing regulations change in the future, we could be subject to severe penalties or be forced to relinquish our interests in those operations. In essence, NIO is warning investors that its VIE structure may be hampered if the PRC decides to take enforcement action under existing law. Finally, as investors saw with the implosion of Luckin Coffee, the lack of proper governmental oversight presents a key risk to investing in PRC-based companies. In the case of NIO, the company states the audit report included in our 2019 annual report is prepared by an auditor who is not inspected by the Public Company Accounting Oversight Board, and as such, you were deprived of the benefits of such inspection. In effect, this means that while an annual audit is being performed, the contents of the audit will never be subject to a review by the PCAOB, a significant risk for investors. So, after nearly going going bankrupt last year, NIO rebounded and closed out the year up over 100 times, a truly historic achievement for the stock. Unfortunately for investors, much of the good news seems to have already been priced in. NIO trades at a nosebleed valuation of 30 times X forward sales, more than double the valuation of Tesla despite a checkered history of success. From a gross margin perspective, the company has consistently operated in the red, only recently turning positive in the past 2 quarters. The company's low gross margins in comparison to its peers are an area of concern. In my opinion, by outsourcing its vehicle production to SAIC and sourcing batteries from third-party suppliers, NIO relinquished control over significant parts of its supply chain where it could have added value, increased margins, and increased its competitive moat. In the long term, especially given the significant capital rises in the form of debt and equity, I would expect NIO to start investing aggressively to expand its production. In fact, we might have seen the beginning of such a strategy with the February 4th announcement to invest in new industrial campuses with the government of Hefei. Aside from investments into production, NIO needs to increase R&D spending to stay competitive in AI and powertrain technology. Over the past 12 months, the company has spent less than $400 million on R&D, a decrease versus the prior LTM period and less than a third of what Tesla is investing. Although NIO has been able to cut its net income and FCC losses in 2020, the vast amount of R&D and expense required on a go-forward basis will prevent the company from achieving meaningful profitability over the foreseeable future. Withdrawing any conclusions on the long-term outlook for the company, I believe 2021 will be a challenging year for NIO share price. Manufacturing cars is a capital-intensive business with long lead times, and the auto industry in general is facing a chip shortage and battery supply constraints. This will make it increasingly challenging to meet the short-term expectations of the market in regards to deliveries and profitability. NIO stock presents a unique combination of legal, operation, and valuation risk. Despite those concerns, investors broadly believe NIO will continue its breakneck growth and eventually become a leader in the Chinese automobile industry and possibly even the global automobile industry. Luckily for NIO, the significant equity and debt capital rises combined with increased close support from their government sponsor may help them bridge the gap towards growing into their valuation and becoming an undisputed leader in the electric vehicle space. To wrap everything up, if you're thinking of investing on NIO on short term, I think you should just leave it. Of course, the information displayed on this video may not come out as expected, and for that reason, I always encourage people to do their own research. By doing my own research, I came out with these conclusions. Now it's your time to show me what you think. Let me know if you find NIO profitable throughout 2021 in the comments down below. Also, don't forget to like, subscribe, and hit the bell button. Thanks for watching, and we'll catch you on the next one.